Good morning. Happy Friday. Today is January 8th, and a very happy New Year to you. Before I get on with today's report, I want to invite you to our open house on January 21st here at our new office, AmeriFirst new office in Walnut Creek. Please look for the address down below. Check out my Facebook business page. Also, we'll be getting invites out to you via email, and hopefully my marketing man, Mike, we'll be giving you a call as well to get your RSVP, and we'll be sending out invites. Anyway, hope to have a great crowd. Love to see you here and kick off the new year together. Okay, what's going on in the markets? Holy cow, the Dow Jones has just been getting hammered up to its worst four-day start in history, I believe, down about 5.2% or 860 points. I think we've been all over the board today. We were up 120, we were down 50. Now we're up again, which is great. I'm glad to see that. But all this going on with the Dow has led to some safe haven buying in mortgage-backed securities and treasuries. We've seen them risen over 100 points since December 30th, which is a good increase. However, we're not really seeing a lot of improvement in interest rates. I'd say they're only just a tad bit lower, maybe about an eighth of a percent where they were over a couple of weeks ago. I'd like to see that come down a little bit more, and I think that maybe the secondary markets are just kind of hedging a little bit. Not sure that this start to the new year, this trend is going to continue. A lot of things going on in the world. We got Korea, doing missile tests, not a good thing. Of course, the continued trouble in the Middle East. We've got China's market. Wow, that's really had a big effect on our markets, and the reason for the decrease. They've had to halt trading twice. With the Chinese markets down over 7% on each one of those days. And of course, it's the second biggest economy in the world. It's affecting Apple stock and iPhone sales, and kind of scary right now to see where things are going. Now, on the positive side, we got a good jobs report out today. However, the one component that was missing from that jobs report that was not positive is no wage inflation. Absolutely none, zero zip. And that is one of the components the Fed is really looking for, is wage inflation, some sign of a little bit of inflation. Ideally, a healthy economy is about 2%, 3% a year. We're seeing none of that, and a big reason for that is a drop in oil prices, and crude oil has fallen like a rock. The good news in that, hopefully lower gas prices at the pump, right? We all appreciate that. However, that adds to the lack of inflation or a deflationary effect in the economy. So is the Fed going to raise rates this year? That's the big question. That's how it affects our interest rates and mortgage-backed securities, right? And I think at the outset we're looking for maybe 3 or 4 little increases this year. Now, at the start of this year, not so much. Hold your horses, because with the stocks going in the tank, economies overseas struggling, no wage inflation, it's hard to say that our economy could support more increases in interest rates. So we'll see where this thing goes. Stay tuned. Again, please mark your calendars for January 21st. We're looking forward to seeing you here. Cheers.